Now, the Kenyan Monetary Policy Committee met today to review market developments and decided to keep its key lending rate unchanged at 9.5%, citing worries about the persistent balance of payments pressures due to a gaping current account deficit. For more analysis on this, we're joined now by the real Chris Mwiga, senior currency dealer at Kenya Commercial Bank. Chris, thank you for joining us this afternoon. I'm calling you the real Chris because I did speak to the other Chris earlier and I thought you were the Chris. So now you come along. Let's talk about this decision. Yes. Completely unsurprising, particularly given, number one, you've got a new government that's likely to come in, a new finance minister that's coming in. You would want to survey the landscape before you take any steps, and the central bank wouldn't want to be seen to be destabilizing that, would they?
No, they would not. But what's most indicative is that, as they mentioned in the MPC statement, core inflation is pretty much below what they expected it to be. It's actually down by five basis points. So the impact of their monetary policy seems to be working. Inflation targeting for them is at 5%. So when everything is put into perspective, it seems like they did not need to do anything in this particular MPC meeting. Probably they would look at what happens towards the next meeting.
So when I was looking at the overall pointers that came out of that statement that they issued, you're talking about a very stable inflation outlook, really tame, and then at the same time you've got a stable exchange rate which hasn't gone anywhere and is likely to increase, yes. To appreciate going forward. So in terms of the outlook for inflation and in terms of drivers for what's likely to be an uptick in inflation, really there's nothing on the horizon there that suggests that they should be worrying about inflation being a threat going forward.
No, there's not really much to worry about, but well, the one flying the ointment is the new devolved government.
Yeah.
The size of the devolved government is significantly huge, and how the government will raise revenues towards meeting the budgets of the different devolved governments. One thing they may do is, unfortunately, they may do some sort of monetary easing, which could then lead into some inflationary pressures. But what we hope is that the demand for money, occasioned by increased expenditures by the devolved governments will actually match out with the supply which has been created through monetary easing and such.
Yeah. Do you anticipate any major change with potentially a new finance minister, of course, now that Uhuru is going to become president, assuming he is confirmed by the Constitutional Court?
Mm-hmm. No, I really don't think there'll be much in terms of change. The only thing to mention is that, there's a Eurobond coming up in November,
mm-hmm.
$1 billion Eurobond. So that could actually put a bit of, it could reduce the strain on domestic borrowing. So probably, as you said, we expect a lull in, or rather, stable conditions in interest rates and exchange rates. So not much excitement this year, probably in the following financial year.
Yeah, the MPC committee cited the issue of the current account deficit, and they noted that that will remain a concern going forward. Are you concerned that that current account could be difficult to finance?
Yes, it's a major concern. As I said, the devolved government will require an expansion in construction,
yeah.
in basic consumption of goods and services. So there'll definitely be pressures on the current account. So in the short run, I'm worried about it, but in the long run, I think that there are possible measures to close the gap, because some of the stuff that is imported into Kenya is unnecessary. Food and some basic things. Like for instance, most of the energy, a good amount of the energy we generate is thermal. So if we moved away from thermal towards renewable, there could be less pressure on that.
Yeah.
But that's more long term. In the short run, the demands are there, the pressures are there. So I'm actually somewhat concerned when you add the fact that the CBK's reserves are below the 4 months of import cover. You begin to understand that there could be some cause for concern.